I'll give you the strategist hedge. There's really no chance that, in my view, I don't know how we avoid a recession.
Hey there, welcome back to Cash Baggy Channel. Today, I want to talk about the warning from Tony Dwyer. Hold on to cash. There's no chance we'd avoid a recession. Join me as I explore the insights and implications of this crucial topic. Let's get started.
Well, CEOs aren't worried about it until they actually have to raise money. Look at what happened with the treasury new issuance. I think a lot of people are looking at maybe the treasury market has been a statement about inflation, but inflation break-evens didn't really move that much.
Tony Dwyer's perspective on the current economic situation raises crucial considerations. Interestingly, despite the ongoing predictions for a slowdown, the economy experienced robust growth in the third quarter, defying expectations. The fact that the Fed's policy tightening didn't immediately crimp consumer spending is noteworthy. However, Dwyer's concern regarding the move in Treasury yields, signaling a potential recession on the horizon, is a vital topic of discussion. He highlights a critical factor. CEOs and companies may not be overly concerned about rising rates until they need to raise capital. Dwyer's reference to the impact of the Treasury's new issuance on the markets, especially with the Fed's quantitative tightening and other factors, underscores the economic landscape's complexity. The key takeaway is that the relationship between Treasury yields, inflation, and overall economic health is multifaceted. This insight reminds you of the intricacies of the global financial system and how even seemingly small shifts in policies and market conditions can have significant ripple effects. As investors and individuals, you must consider various factors, including monetary policy, global market dynamics, and regulatory changes in your financial decision-making to navigate potential challenges effectively. While you've heard from several insightful economists and strategists who align with the soft landing camp, anticipating a recession's return to a manageable 2% without a significant economic downturn, it's crucial to highlight that Tony Dwyer's stance sets him apart. Tony's perspective suggests that you might be on the cusp of a recession, making this discussion all the more thought-provoking and significant. Let's explore this further.
Throughout the year was that a soft landing scenario is the worst case scenario because it creates that perception of higher for longer interest rates, which keeps them rising. Interest rates on the intermediate and long end of the curve are up 25% from where they were in the beginning of September.
Tony Dwyer's perspective emphasizes that a soft landing scenario might not be the best case outcome, as it could perpetuate a cycle of rising interest rates, particularly on the intermediate and long ends of the yield curve. In recent months, you've witnessed a significant increase in these rates, challenging the notion of a soft landing. This insight aligns with the idea that CEOs and companies may not react strongly to rising rates until they need to raise capital at higher rates. Dwyer's point about Janet Yellen's announcement to raise $1 trillion in Q3 at a higher interest rate than previous issuances highlights a critical aspect. When corporations are required to reissue or issue debt, the cost of borrowing becomes a more substantial concern for CEOs. The concept of higher for shorter implies that the market may be headed towards a recession, leading to potential interest rate cuts by the Federal Reserve to stimulate the economy. This insight underscores the interconnected nature of economic factors, where interest rates, corporate debt, and the economy's overall health are intertwined.
Even in a soft landing scenario, if you look at 1966 or 1995, you had at least a 200 basis point move in long duration treasury yields. So you really need a huge move coming out of the treasuries, but also the mortgages and corporates, and that has to come from a major tone change in the Fed.
Here's an analysis of the factors underlying his arguments. 1. Historical precedents. Dwyer draws from historical examples, such as 1966 and 1995, to highlight that significant moves in long-duration Treasury yields, around 200 basis points or more, are typically required even in a soft landing scenario. This historical context emphasizes the magnitude of change necessary in the bond market. 2. Fed's role. Dwyer emphasizes that such a substantial shift in bond yields usually comes from a major change in the Federal Reserve's tone. The Fed may cut rates, but this shift in stance is typically triggered by specific events or notably weaker economic data. 3. Historical event, 1995. Dwyer refers to the Orange County bankruptcy in 1994 as a significant event that prompted the Fed to change its tone aggressively. This event eventually led to the Fed's last rate hike in February 1995. Still, by then, Treasury, mortgage, and corporate rates had dropped substantially. 4. The key differentiator. Dwyer's key point is that the pivotal factor is identifying what event or economic development in 2023 might lead the Fed to change its tone dramatically, causing significant rallies in various financial instruments. This change in tone and subsequent market movements could ultimately contribute to an improved economic outlook.
You're in the wrong place here, but to me, you can't figure it by definition. It would be discounted if you knew what it could be. It's something that typically, like long-term capital in 1998, we knew that rates were going up and mortgages were becoming an issue.
The essence of Tony Dwyer's perspective lies in the unpredictability of significant market-moving events. He parallels historical instances like long-term capital's crisis in 1998 and Orange County's bankruptcy in 1994 to emphasize that major disruptions often take market participants by surprise. Dwyer's central argument is that these transformative events are challenging to foresee because they would already be factored into market prices if they were foreseeable. It is the unanticipated and unforeseeable developments that take everyone by surprise. In his opinion, Dwyer suggests that you might be approaching a similar juncture, where an unforeseen event could trigger a shift in market dynamics. This shift could manifest in lower yields, which in turn might temporarily bolster stock markets. Although you cannot precisely predict the nature or timing of these unexpected events, acknowledging their potential impact on financial markets is crucial. It underscores the importance of investors being vigilant, adaptable, and ready for unforeseen developments in an ever-changing economic landscape.
So I think if you have to be invested, I think it's not defensive because the end of the world is coming. For a lot of stocks like financials, it's already happened. I mean, the Russell 2000 is down 33%. So somebody's got to tell me it's been a great year for stocks. From peak, I'm talking about.
Tony Dwyer's recent insight, urging individuals to hold on to cash, and his assertion that there's no chance of avoiding a recession, opens the door to a crucial and stimulating discussion in the financial world. Dwyer's caution is not meant to instill fear, but to inspire preparedness. The advice to hold on to cash carries a powerful message about the importance of liquidity in uncertain times. Having accessible funds at your fingertips serves as a financial safety net, ready to seize opportunities that arise when markets become turbulent. It empowers you to resist impulsive decisions, like hastily selling investments at a loss to meet immediate financial needs. Dwyer's statement about the inevitability of a recession resonates with the sentiment shared by many financial experts and economists. It's a reminder that economic cycles are a natural part of the financial landscape, influenced by many factors. Recessions can be triggered by economic imbalances, geopolitical events, or unforeseen global shocks, such as the recent pandemic. Dwyer's perspective is a call to action, encouraging investors and individuals to prepare for potential economic challenges. While holding onto cash is a key aspect of a well-rounded financial strategy, it's vital to recognize that investment decisions shouldn't be solely fear-driven. Instead, it's about creating a robust financial plan that includes diversifying your portfolio and staying informed about economic trends. Adaptability and knowledge are your greatest allies when making strategic and well-informed financial decisions in the ever-evolving economic landscape. Tony Dwyer's insight regarding the importance of holding onto cash in the face of an impending recession isn't a signal to retreat, it's a rallying cry to stay prepared and vigilant. It's a reminder of the value of having a financial cushion during uncertain times. It underscores the broader significance of a diversified and informed investment strategy. Dwyer's wisdom encourages you to stand firm and be proactive in a world of financial ups and downs. By adopting these principles, you can confidently navigate the turbulent seas of finance, knowing you're prepared for whatever challenges lie ahead. Thank you for watching. Feel free to share your insights in the comment section below. Remember to hit the subscribe button to access additional informative content here on Cash Baggy channel, and stay tuned for my forthcoming videos.